secure, decentralized, unhackable. You just tapped buy on your crypto app, but what if you didn't? What if the system processing your transaction isn't as neutral as it looks? Imagine the timeline rewinding. Your transaction vanishes, only to reappear elsewhere. What if it could be delayed, reordered, or even entirely reversed? We're always told there's no central authority, right? But that doesn't mean there's no control. Because when systems disagree, they split. Billions lost. Networks manipulated. And here's the absolute craziest part. Most of it happens exactly as designed. Because blockchain security isn't just about code. It's about who has the power to change the rules. Welcome to The Explainer. Today, we're uncovering why blockchain isn't as secure as you think and breaking down the real attacks. This video on the channel, Blocks, Bonds, Funds, is created for educational and informational purposes only and does not constitute financial or investment advice. Okay, let's dive straight into this. We constantly hear that blockchains run on perfect cryptography, distributed consensus, and pure math. No central authority, absolutely no single point of failure. I mean, it sounds completely impenetrable, right? So here's the big question. Why do billions still get lost every single year? Well, because the illusion of this perfect, flat, decentralized network hides a much messier truth. In reality, it's a deeply layered system that is just full of highly exploitable intersections. You see, blockchain security isn't just one single thing. It's an entire ecosystem. We're talking protocol, validators, networks, smart contracts, and humans. And here's the kicker. Every single layer introduces its own unique risk. Attackers, they aren't usually sitting around trying to crack the underlying cryptography of Bitcoin or Ethereum. Honestly, that's practically impossible. Instead, they don't break the blockchain itself. They exploit the seams right between these layers. So let's start at the base layer. If you've spent any time in crypto at all, you've probably heard of the 51% attack. Basically, if a single entity, like say a massive mining pool, gains control of a majority of the network's computing power, they can literally rewrite history. They can secretly generate an alternative chain and then just override the public truth. It proves a pretty harsh reality. Decentralization works beautifully right up until it doesn't. And this brilliantly illustrates how the fundamental rules can be broken. Blockchain is literally designed to prevent double spending, but under the right conditions, yeah, it still happens. Imagine this. An attacker sends you funds on the public chain. You hand over the goods, but then they suddenly broadcast their own hidden, longer chain where those exact same funds were actually sent back to themselves. The network accepts the attacker's history as the new truth. Poof, your transaction vanishes and your money is gone. But wait, here's a truly terrifying statistic for you. An attacker doesn't always need 51% of the power to cheat. No way. Research shows that under certain conditions, they need as little as 21.48%. Let that sink in. You don't need full control of the network, just enough to game the system's incentives. It's called selfish mining. A miner finds a block, keeps it private to build a lead, and then strategically releases it just to force honest miners to waste their computing power. Furthermore, you don't even need mining power to manipulate a blockchain. You can literally just attack the network plumbing by hijacking routing protocols in what's known as an eclipse attack. An attacker can completely isolate a node's connections. They just delay or isolate those incoming and outgoing connections, and suddenly they're feeding that node a distorted reality without breaking a single line of consensus code. Now let's move up a bit, because even when the network functions honestly, there's exploitation built right into the actual rules. Enter MEV, or maximal extractable value. Whoever builds the block has the power to peek into the public waiting room of transactions, reorder them, and insert their own just to make a profit. So transactions aren't processed fairly, they're processed profitably. The system isn't neutral at all, guys. It's entirely incentive-driven. Let's see how this builds into one of the most frustrating exploits out there, the sandwich attack. Basically, a searcher bot spots your large pending trade. Because they see your order before it's finalized, they front-run you. They pay a slightly higher fee to buy that exact asset milliseconds before you do, which drives the price up. Then they backrun you by immediately selling it back for quick profit. You just got sandwiched. And sitting right on top of the protocol are the applications themselves, smart contracts. Now, smart contracts might be stored on an immutable blockchain, but guess what? They are written by humans, and humans, well, we make mistakes. Simple coding errors act as massive open backdoors, allowing attackers to instantly drain millions of dollars. The blockchain just flawlessly executes the flawed code. So, code is law, until it's wrong. And it gets even riskier when blockchains try to talk to the outside world. The absolute weakest links in the entire ecosystem are exactly where blockchains connect externally. We're talking bridges transferring assets across chains and oracles feeding real-world data in. If an attacker manipulates the oracle feeding price data to a lending platform, they can borrow millions against completely worthless collateral before the system even realizes it's been tricked. Moving all the way up the stack, we finally hit the ultimate attack vector. You can have flawless cryptography, you can have perfect code, but none of that matters, literally none of it, if a user is tricked into handing over their private keys. Whether it's through a phishing site or a malicious wallet approval, attackers know that tricking a human is infinitely easier than breaking encryption. The biggest vulnerability isn't the blockchain, it's you. So the crucial point here is that we're left with a massive paradox. We all strive for complete decentralization, a system owned by absolutely no one. But the reality? The more decentralized a system becomes, the harder it is for everyday users to coordinate. And that's exactly where hidden power emerges. Highly capitalized groups, like mining pools, massive token holders, and those MEV searchers, they build these hidden power structures. Security isn't just protection, it's about influence. When you hit buy on that app, you're not interacting with perfect security. You are engaging with a layered, contested arena where every single step is a battleground for incentives and influence. So, looking at everything we've unpacked in this explainer today, the real question we should be asking isn't, is blockchain secure? It's secure for whom? Thanks for joining us, and always keep questioning the systems around you.